Alrighty, good morning. This is Axel Merk, President and Chief Investment Officer of Merk Investments with my morning update. I try to do these at 7 Pacific time, 10 Eastern time, but my day job is not to give these broadcasts, but to take care of other things, so there are often some slight delays, and then often, of course, I have meetings, and I do them later, and so this is still all kind of beta experimental phase. Please give me input what you'd like me to cover on these. One of the things that just got delayed, one of my analysts just sent me the charts of the spreads of the state municipal bonds versus U.S. Treasuries. I have them in my Twitter feed, and the reason why that's starting to be something we should look at more closely is because Mitch McConnell suggested that states should be allowed to file for bankruptcy. And if you know about the Eurozone and heard about the Eurozone, when the talk had been that states should be able to default, well, that wasn't taken too kindly on the weaker states. The spreads blew out. They were unable to borrow anymore, and then Mr. Draghi had to come in and promise to do whatever it takes. Now, all that said, the bankruptcy process is, of course, a vital one for capitalism in many ways. If you price in that risk accordingly, just changing the rules along the way is usually not a good idea, which is the type of thing that happens during financial crises. And what was missing in the Eurozone is mainly a well-established process. I'd argued for a long time that the goal is really to get the system to be strong enough to stomach the default of a state, because at some point it may well happen. And so similarly in the U.S., if you allow states to file for bankruptcy, you need to have a process, an orderly process, and so that people can plan and price it in. And just like banks go belly up all the time, there's FDIC insurance. There's a process here to deal with that. Now, obviously, FDIC insurance provides a bailout for depositors. But the question is kind of if you don't have a process, then markets will be more chaotic and will be more disruptive, and so that's the sort of thing that I'm trying to look out for if indeed the talk is picking up about allowing states to file for bankruptcy. That's yet another thing that we may want to be concerned about, and the numbers could be reasonably significant. Other items happening. Obviously, everybody knows jobless claims were out today. They were only 4.43 million. The estimates had a range of about 3 million, so it just shows you that nobody really has a clue of what they should be. Some are celebrating that we're coming down on the second derivative here, and that's a reason to celebrate. Ultimately, I think none of us know how this is exactly going to play out for the economy. An analyst on Bloomberg today said that if you look at China, with obviously the disclosure that China is not the U.S., that yes, factories were turned back on, and in the U.S. as well, you can ramp up production again when the shelter-in-place phase is over. But services in China haven't picked up substantially. On the weekends, you see there's less traffic, and also otherwise the service sector isn't picking up as much. And again, in China, of course, you can coerce people to ramp up production, but I wouldn't be surprised if there are some similar things happening here, the sort of thing that you can direct from the top, and the top might just be the boss of the business, right? You can produce gadgets and stuff inventory. Doesn't mean people are going to buy them. And so similarly, I wouldn't be surprised if on the services side, maybe not the hairdressers, people do need a haircut, so maybe there's going to be a bounce back for those daring enough to go getting a haircut. But generally speaking, I would not be surprised if things go not straight back to normal, if people are going to be reluctant to go back to consume entertainment in the stadium rather than on the couch. And of course, many people will go back, but not everybody. The same analyst, by the way, pointed out that historically it takes about 5 times as long to have the recovery as it is to have the contraction. And so even if we only have a 2-month contraction, we may well have a 10-month period to recover. And by the way, one thing to note is the recovery starts when you're at the bottom. And bit of an uptick in the number, that's then no longer considered to be, well, at least a quarter an uptick, that is then no longer considered to be in the recession. And so who knows how that will look. Now, obviously, we have many, many distortions happening, most notably that we're keeping up production capacity and by bailing out everybody. And the question is, what will be the tail end of that thing? And let me pivot here to a debate that's making broader circles about inflation. Is this going to be inflationary? The Wall Street Journal, journalist Greg Abe wrote an article, says that now there is no inflationary concern. And the emphasis, I suppose, is on no. I've known Greg for many years. He was at the Wall Street Journal and was editor at The Economist, is now back at the Wall Street Journal, writes more opinion pieces, always ready, able, and willing to support money printing, but otherwise very good in his analysis. Worth reading, definitely. But the tail end of this is what concerns me. Right now, yes, we are overproducing, and will continue to overproduce, while at the same time consumers may not be there to kind of have that demand, and that usually leads to lower prices. Now, if you think that this is the same sort of thing that happened after the financial crisis, where we similarly that savings were too high, at least according to kind of economists, and then central banks try to coerce things with easy money. Well, we'll see much more of that. But will we get the sort of Goldilocks sort of environment we had last time? And the big caution I have is that Bernanke, let's take him. First of all, when he talks about inflation and the tail end of that, he covers his bets. If you watch his interviews, he's hedging his bets there a little bit and said, yep, we could well see inflation. And by the way, incentives are there to have inflation. You need to socialize this massive government spending if you're the policymaker anywhere around the world. And so there's certainly a huge incentive there. So can they succeed? Last time around, we had restrictive fiscal policy. Bernanke said he could have done more on the monetary side. And then, yes, we had a fiscal stimulus called a tax cut. And if you take all of that together compared to what we have now, monetary efforts are dramatically larger. And then a corporate tax cut, yes, it's stimulative, and yes, may, and I caution about that, if we push things too far and run the economy too hot, might lead to inflation. But if we are going to get an infrastructure spending bill, which apparently both Democrats and Republicans are in favor for, or something along those lines, that has a far more direct impact on inflation than a corporate tax cut. So the sort of policy response we have is far more inflationary than the sort of policy responses we had during the financial crisis. And is, of course, massive. I mean, with in excess of 10% of GDP type of stimuli that we're putting in place here. And so I don't know whether we'll get inflation. I certainly think that there's a risk that we'll get inflation, and investors may want to think about whether they want to take that into account. By the way, my eyes are glazing always a little higher because I have a Bloomberg screen that I have on top and of the camera, and if I look at West Texas crude, I see it up $3.80 at 17.80 for the June contract. But if I look here on my lower right-hand side of the screen, I see it at 10.01. I think that could be minus 27%, but it could still be the May contract, but that should be off the board. So I'll check on that. In any case, I had some moves here. The yen suddenly at 9:30 Eastern time plunged a little bit, and that was because the Bank of Japan doubled some of its bond buying programs. It has since regained half of that loss, so to speak. And so those huge monetary injections, they last for a few minutes usually. Gold on the spot price is up $21 or 1.25% at 17.35. The futures is at 17.60 or up 22.30 as here I speak. And so those buying gold, let's say that there is going to be inflation. Well, how do you hedge against inflation? What do you do in your portfolio? And we've had these discussions here. Now, yesterday somebody asked me, how do you think the yield curve is going to be? Where's the long one going to be? If it's inflationary, isn't the long one going to fall? And the thing is, it's very easy to talk about, there's going to be inflation pickup. Well, how do you implement it in your portfolio? And if you take the margin for a second, anybody who is traded the 10-year or something equivalent, knows a few things. First of all, if you're short bonds, you have a negative carry. If you do it with an ETF, you have the cost of an ETF on top of that. So that's one thing. The other thing is anybody knows that bonds, the longer you're out on the yield curve, are influenced by many, many factors, not just inflation. It's growth outlook on the economy. It's whether we have a risk-on, risk-off environment. A risk-off environment, often bonds are rallying. And so you might be right on the substance, but that doesn't mean you've chosen the right instrument to implement it. If you take inflation itself, you can actually trade inflation. There are so-called inflation swaps you can trade. It's an over-the-counter instrument. And by all means, let me just probably do this, put in here my daily disclosure. That one is mostly focused on. But more broadly speaking, also on instruments derivatives, we're not making any recommendation here. Certainly nothing specific. We're certainly not encouraging you to trade derivatives. I'm just trying to illustrate a point here. So you have to be a qualified, eligible participant, meaning somebody of substantial size to engage in these contracts. But if you were to trade one of these inflation swaps, which is the most direct thing on inflation you can do, you have to pick a point in time in the future where that's where that contract is. And what it is pretty much, it's a bet on the CPI at that point in time. And of course, it is not relative to today, it is relative to what is already priced into the market. And now, I'm on board with those say that the current phase is not inflationary, at least as far as CPI is concerned, it's disinflationary. So we might get a reduction in CPI. And so it could be that say, all right, well, let's say you take a position in 3 years, there's going to be inflation, and I'm going to buy this inflation swap 3 years out. Well, if we have let's say there is going to be 3, 5, 6, 7 higher inflation at that point in time, you've got to get that level right. And if we have a bout of disinflation first, who knows? And so getting and then on top of that, these markets, they're over the counter, the spreads are not low, and so you've got to price that in as well. But in any case, it's much easier said than done that there's going to be inflation and actually do something about it. You can take the position, equity prices go up in an inflation environment, right? Or you can say gold goes up in an inflation environment. Now, ultimately, of course, as an investor, you tend to take a diversified approach to it. At least many do, and again, there's not a recommendation, but one of the reasons why the price of gold has been moving higher is because it's one of the simpler ways of diversifying. Gold is also a negative carry asset in that sense. Gold doesn't pay a dividend, and it costs to hold gold. And so from that point of view, but the cost is low compared to many other ways of diversifying and hedging. The positive carry asset is equities. And so you can say all this money printing is going to inflate asset prices. And of course, all of these are bound to have many, many risks. And so I'm not going to go into each one of them right now, but just as a heads up that there are some concerns. Let me just pull up, I had some notes here. One thing that was out in the news just a little while ago, about 100 food inspectors are sick with the coronavirus. So just think about what that means, except other than the hardship, of course, on the families, the disruption that causes. Several meat processing plants have been shut down, and there's talk about in Missouri, I believe, that apparently there's a pickup in cases, possibly linked to these meat packing places. So you have these places that might have the virus. You have the inspectors that get infected. You have inspectors going to multiple other places to inspect other food, thereby potentially affecting or infecting other people in the food industry. And so one of the reasons meat prices are up is because there are concerns about the supply chain. And just linking it back to inflation, if and when we do get inflation, as a reminder, we talk about inflation as a CPI moving higher. Well, first of all, the current consumption basket is not what's reflected in CPI. So it's just we have very different, because of the shelter in place. The CPI is really garbage. There's no, and any economist is probably going to agree into that. The CPI is supposed to reflect what we're consuming right now, and that consumption basket. The economists cannot possibly update that fast enough because it's just completely different from it was a few weeks ago. But in any case, when we have inflation, it is not as if inflation were to uniformly rise. Usually you have a spike here and there. And fear not, then government comes in and is going to regulate things and is going to create some other unintended consequences. So if you go back to the 1970s, we had a lot of that. And so yes, I mean, the spike in food prices, it is isolated and related to a specific reason. But maybe there's going to be more isolated cases here and there, and suddenly you have a trend, right? And so I'm not suggesting that this is the beginning of inflation more broadly, because I do think that disinflationary forces in the short term are going to outweigh it. But I do think they are not to be shrugged off, because there may well be a pattern. We may get, I mean, we have disruptions in other goods, right? And masks certainly, there's a shortage of those. And we see that it seems to be very popular to have protectionism right now. Well, protectionism means higher prices. Because we source goods from fewer places. So there are all these sort of things that I think we do have to be cognizant of and humble enough to say, all right, this may well cause some issues here and there, simply because certain prices stay low. And then, of course, if you produce a car, right, you don't know what to do with them. Nobody wants to buy a car right now. And so those prices will probably be depressed then because those are big ticket items. Maybe they outweigh certain things. Good. So let me just give you a quick data update on a few other things here. The 10 years up a tick, the 30 years up 17 ticks, the 3-month LIBOR is at 104, same as yesterday, by the way. The Fed funds effective rate is at 4 basis points. The 3-month T-bill is at 10 basis points. That's a basis point or two higher than yesterday. And if I look on the board here, anything exciting? Norwegian kroner finally has a good day. Currency has been quite depressed together with the other commodity currencies. They're also doing reasonably well. The euro is kind of flattish, with the Swiss franc being the weakest one. And then, of course, yes, the S&P futures are currently $34. Good. Let me leave it at that for now. Hope you're having a great day. Stay in touch, and looking forward to chatting with you in the near future. If I find my mouse, I can even turn this off. All right. Thanks, and take care.